What a difference 2 months can make, especially in this market. 2 minutes can make a huge difference in this market. So last time we spoke in May, we were looking forward to the Greek elections. What has happened since then? How are we trading this market? And do we love the dollar again?
The market does seem to love the dollar again, although it's really not love. It's more like just, it's the least dirty shirt in the closet, I guess, is the popular phrase they're using right now. But the truth is, the dollar is really actually a very dangerous trade in my opinion right now. The way that I'm trading it is, first of all, I mean, obviously there's so much going on in Europe, but we also have in the U.S. We really don't know what Bernanke's going to do in the Fed. We don't know if there's going to be QE3, and it becomes a binary trade where the dollar is either going to go way up or way down. You know, obviously, if there's quantitative easing, the dollar should fall, and if it doesn't, and the world economies continue to slow, the dollar should continue to gain as it has been gaining on bad news. When there's bad news, people run to the dollar.
Well, we know that they're definitely going to do something because in his language yesterday, he said that they will use whatever tools they have at their disposal. So a couple questions here. Do we need to do another QE3, and what size is going to make people happy?
Oh, that's a great question because, you know, I think a lot of people missed it. But last month, Bernanke actually used the term diminishing returns to refer to quantitative easing, which leads me to believe that he's maybe not that excited about doing it. I do think it's going to happen. You look at the economic numbers, they're just not good. That retail sales number earlier this week, that was just terrible. So I think basically Bernanke has one bullet left in the chamber. That's going to be QE3. He doesn't want to use it until he absolutely has to. So I don't think, you know, I don't think you're going to see it right away. And, you know, a lot of people, I think, though, are overestimating the reaction. Because if you think back, the first time we had quantitative easing, nobody really knew what to expect, and the markets took off and flew. But the truth is now everybody's expecting it. Everybody's anticipating it. And so you're bound to have, as Bernanke said, diminished returns. So
is that baked in then? Because the market's been bid up pretty nice in spite of not such great economic data.
That's true. This market truly has a bid. It truly has a bid under it. I mean, you have to look at that and say, wow, you know, I thought all these bad things were going to happen, and they did, but the market just won't go down. Now, I do think some of that is anticipation of quantitative easing coming forward. Perhaps they're going to buy mortgage bonds. You don't know how it's going to, what exact form it might take. But I do think something's going to happen. But at the same time, this bid that we've seen on the market, I think we're kind of pricing it in. And that means once it does happen, you're going to get some people who are buying it. You're going to get some people who are selling the news because they bought the rumor. So I'm not expecting that much. It's not going to save us. And I would say that, you know, the results have been mixed thus far, and I don't really expect that to change. It's
so funny because regardless of what asset class or investment style you talk about, everyone is literally saying Q3 we expect more sideways sloppy action. Maybe something will get going in October, and if you even look at, you know, a piece of granular data like short interest on the New York, that kind of supports it as well because everyone has to keep up with performance, and if PMs are underperforming, they are going to have to do something about those shorts. And again, it sort of lends to that whole October theory. But let's take this back to the FX conversation because if you go through Bernanke's language yesterday, if you strip out Europe, the U.S. is really the place to be.
Yeah, that's true. And the way that I'm playing it might be a little bit different from what others are suggesting because I'm not really recommending that you trade the dollar because to me the dollar is a binary event right now. It's going to go way up or way down. So trade the crosses, right? I think the euro is going to underperform the Australian dollar no matter what happens with the U.S., no matter what happens with Bernanke. I just think the Australian dollar is a better currency to own. It's going to pay interest. So instead of just going long Aussie, going long FXA in the stock market, I can go long FXA and short FXE.
Now, is that what a cross means to our newer FX traders?
Right. In other words, I'm just taking the dollar out of the equation at all. It's just like, it's very much like a pair trade where someone says, I think company A is going to outperform company B, and therefore I go long A and short B, and I make the difference. And it's really a non-directional trade. It's a you're not really betting on
market neutral?
Yeah, it's market neutral, exactly. And this is sort of market neutral in the sense it's dollar neutral. And the dollar is the king dollar, of course, and the dollar is 90% of all currency transactions. This is a dollar neutral trade because I don't know what Bernanke is going to do. And let me tell you something, if you're on the wrong side of that trade, if you guess wrong on Bernanke, you could get clocked, you know? It could get pretty ugly. So I would say don't trade the dollar, or if you do trade the dollar, hedge. Right, and something like long FXA, short FXE, that's long Australian dollar, short the euro, because I think no matter what Bernanke does, Australia is just better positioned. It's a better economy. You get paid to hold on to the Australian dollar. There's actually interest to collect on it. So there's a lot of good reasons to hold Aussie as opposed to the euro.
And to wrap it up, let's talk about the yen, because last time we spoke, we looked at that in terms of a measure of economic strength, but we haven't heard you mention that in this conversation.
Yeah, you know, the yen has actually been kind of boring lately, believe it or not, especially against the dollar. It's really trapped in a very narrow range. And the reason is because, you know, the yen does very well. As I said, the yen loves misery is the way I like to put it. But the dollar does too. And so, you know, when people are scared, they're buying yen and they're buying dollars. And the dollar-yen pair doesn't really move that much. And then when they're not afraid, when they feel better, when they think something's good's going to happen, then they're selling the dollar and they're selling the yen at the same time. And again, it doesn't really move. So you're just not seeing that much action in dollar-yen. And that's why you don't really hear me. There's other currency pairs. I don't talk about dollar Canada either.
Right.
Dollar Canada is just
the same.
It's frozen.
Right.
It just won't go anywhere. So there are certain pairs, I guess you could say, it's fair to say that, you know, they become immobile for fundamental reasons like dollar yen, and because of that, it's just not that interesting of a trade right now.
All right. Well, can't wait to have this conversation again in August. Thanks, Ed.
Always a pleasure, Jill.